Hello, everyone. Thank you for joining us today. I think we'll get started. Our presentation today will feature Claire Massesson, our Vice President of Farmer Relations, and Alyssa Shear, our Credit Manager. They will be giving us a presentation about the farmer due diligence and underwriting process at Iroquois Valley. During the presentation, we will have time for Q&A, so please submit any questions using the Q&A feature at the bottom of your screen. Claire and Alyssa will do their best to answer the questions live. And if there are any questions at the end, we will address them then. Also, please note that this webinar is being recorded and will be posted to our website in the following days. I would like to briefly introduce Claire and Alyssa before they begin. Claire serves as Vice President of Farmer Relations at Iroquois Valley. Her work centers on process, program development, and resource building. She joined Iroquois Valley in 2015 as Communications Director, and in that position, she gravitated towards stakeholder engagement as she connected with the farmers to share their stories. She eventually transitioned to Farmer Relations in 2021. Claire currently lives in Southern California, where she enjoys gardening and all things outdoors, especially camping. Alyssa serves as Credit Manager at Iroquois Valley. In this position, Alyssa focuses on the financial viability and structure of all potential lending opportunities. Prior to joining Iroquois Valley in 2020 as an underwriter, Alyssa worked in the tax and accounting field, specializing in tax prep, bookkeeping, and succession planning for farming operations. Alyssa resides in Northeast Indiana with her husband and 3 children, where they are an active part of their family's 4th-generation farm. Now I will hand it over to Claire and Alyssa for their presentation.
Thank you, Lacey, and thank you so much to everyone who's joined us today. I wanted to add that we work extremely closely with our Senior Relationship Manager, Rhea Carr, and a lot of what we'll be talking about today is work that both she and I do a lot with Alyssa as we're evaluating the investment making process. We wanted to start with a quick little overview of where we are today. We're excited to talk to you about how we evaluate investments, but we've also been in business since 2007. So we have a large portfolio now spanning 19 states, 3 of which we entered last year. So that was our first investments in North Carolina, Kansas, and Missouri. This is kind of a snapshot of how we've gotten to, we're going to focus on how we got to where we are and how we're growing the portfolio, but this is a little bit of what we do. There's 2 things I wanted to point out. One, in that production mix graphic, 12% says diversified, and I wanted people to understand what that meant. That means multiple enterprises. So say someone's raising livestock on pasture in addition to a crop rotation, that's kind of what we consider that. It's more than one distinction. And then the other thing I wanted to point out is that within our 3 core products, we buy farmland and we lease it to organic and transitioning farmers. We also do lending and provide mortgage financing to farmers. And recently in 2019, we started offering lines of credit. So that's what our asset breakdown at the moment is. For farmland that we own and lease to farmers, we make it possible for the farmer to purchase the land at or after 7 years. So even if they're leasing with us, they do have the ongoing opportunity to own that land someday. So we can go on to the next one. This is another picture of where we are today. Whenever we are evaluating new opportunities, we are weighing a lot of different factors. I looked at our investment reports and I counted 27 metrics, both financial and qualitative, stuff like business, their land stewardship practices, their experience, community engagement, their own background. So we are evaluating investments on a very wide variety of factors. And so we're always looking to prioritize diversity within the portfolio, whether that's the actual demographic or whether that's involving many different operation types. And so like the slide before showed, we have a lot of different operation types. We also seek to prioritize operations that are inclusive and that have multiple operators. Because we work with family farms, we have a large percentage of our portfolio that involve women on farms, and that's technically an underserved category within the USDA. And so it's nice to see that our portfolio is more inclusive of that metric. So we can go on to the next. One thing that everyone has in common within our portfolio is their commitment to organic. We stand by this standard because it remains the only legally defined certification within the world of certifications out there today. So USDA organic is a legally defined and enforceable standard. It's run by the National Organic Program. We work with farmers that are already organic as well as transitioning to organic, but we don't necessarily stop there. Although we don't require additional certifications, we do see a lot of farmers working with kind of beyond organic, and that's typically for their own market differentiation or, related to their values. So these are just a few examples of some of the additional certifications that we see. One thing that's not on here is the Real Organic Project, which is a nonprofit dedicated to holding the organic standard strong. And so all of these represent different elements. And for anyone not familiar with the one on the bottom left, that's the Regenerative Organic Standard. That's one of the newer ones out by Patagonia and Dr. Bronner's and the Rodale Institute. And so that operation is the only regenerative organic certified one in the portfolio now, but we have a few others that have looked at it and are evaluating it. We can go on to the next. All right. So we are going to spend a lot of time on this, and Alyssa's definitely going to have plenty to say here, but we wanted to talk through this because this is really what we're all here for today. I'm going to kind of set the stage. I think that our model is unique because we never just look for farmland to purchase. That first react to farmer need is very accurate. Every investment that we make is the direct result of a farmer bringing a specific opportunity to us that meets their needs to either expand or sometimes establish their operation. We're going to walk through this process kind of generally, and then we're going to go through an example. But I'm going to pass it to Alyssa to talk about this evaluate and underwrite, because we could spend a lot of time on this one.
Yes, thank you, Claire. So when a deal gets to the evaluate and underwrite stage, that is the point where they have went through a brief questionnaire with us, given us some qualitative answers, and then we have now moved on to the quantitative part of the assessment. So there's some core documents that we usually request to start off the underwriting phase of a deal. Those include 3 years of tax returns, a balance sheet, a cash flow, and also a crop plan for the acres that they are wanting to add to their operation. So there are a few minimum requirements for the financial part of the underwriting. I know there was a question before the webinar about deal breakers or potential no's, why we would stop a deal. One of our minimum requirements on the financial quantitative side is we do ask that there is a 600 minimum credit score rating. There are some other deal specific requirements as far as line of credit, lease, and mortgage. We do ask on our line of credits that there's a debt to equity ratio of 80% maintained throughout the life of the line. So once those have been assessed and everything clear, we then move on to actually the underwriting. The primary focus of the risk assessment is factors that we determine ranges on, and that helps us determine a set rate for a financing opportunity. So right now we have a rate scale that ranges from about 5 to 7%. A lot of our deals end up in the 6.5% range. We look at things like the credit score, like I mentioned, loan to value of these deals. We do mortgage specifically, we do ask that the collateral value is at 75% or less. We also look at debt to income, cash flow to debt, debt to equity, and their debt service coverage ratio. So several factors on the quantitative side. And then aside from those factors that are more balance sheet heavy and really speak to determining rate, on the cash flow side, we also weigh heavily on a farmer's ability to project a cash flow for their current operation, and also we call it a crop plan for their desired acres that they're coming to us for. We like to see that there is a plan in place for their operation, and that they have gauged their expectation for liquidity in their day-to-day operations, and really have the ability to be able to service a payment back to us. I do want to take a minute, because there are some things we are doing internally to help this process along as well. There's a couple new software implementations that we are currently undergoing. Typically, Abrigo is one that we are in the middle of implementing, and this is going to help us with our underwriting of mortgages and lines of credits, but it's also going to help us as a company manage the workflow, our pipeline, and really help us to report on some of these key factors as well that we look at post deals. The other one we are implementing is Tillable. That is more lease specific, and with Tillable, we are able to research and access comps for deals that might not have the timeline to be able to be appraised before closing. I know that was a question prior to the webinar as well. Or in a situation where we have been approached for an auction situation, we're to kind of gauge what our expectation for value is before those situations as well. Aside from using it as a comp tool, we will also be using it to house our lease information, and it will be hopefully in the future an interactive tool between us and our farmers to be able to house some critical data for soil health tracking, rotations, and much more. So that's really the evaluate and underwrite stage of the process of our farmers moving through our pipeline. To move to the next one, finance one deal at a time. Once a deal has made it through the evaluate and underwrite stage, then it becomes time to take it to our investment committee. And that is an internal committee made up of staff and board members that analyze deal and then approve or ask more questions or potentially deny the deal. So once it has come to investment committee and that approval has been offered, then a commitment letter is issued to the farmer. And once that commitment letter is signed, which we do a commitment letter in all lending opportunities for leases, for financing, and for lines of credit. So that would be a standard step across the board. Once that commitment letter is issued and signed, then we move on to the closing process. We, depending on the deal, we do connect with outside legal help to get us to closing. And I carry that part of the deal as well, all through closing. And then At that point, once it is closed and settled, then the RM, relationship manager in the situation, usually steps back in and takes back over that relationship to help out with the transition after that. So I'm going to check the Q&A real fast, Claire, but do you
Yeah, I
want
was
to
going
go
to.
ahead and
Yeah, I think Sarah brought up a good question of, do we offer advisory services to potential borrowers who may not meet criteria initially? And yes, so if we do turn down a deal, oftentimes if it's mostly based on financial factors, we can say, you were not ready to make this investment. Here's why. Here's some feedback of what you might need to do. We also work with some technical assistance providers. We have a few grants out where we're able to connect farmers to free financial and business planning through the Food Finance Institute. That's typically for beginning farmers, and that's been a popular program that we've been able to put about 20 folks either that we were underwriting or that are already in the portfolio through. But typically, yes, we do give a lot of people feedback about why or why not they might not be able to work with us and what they might need to do in the future. There's also a question about what percentage of deals enter the evaluate and underwriting stage and go on to the next. And actually, we kind of break this out even further. So there may be a number of opportunities that come to us for evaluation. Typically, we don't consider anyone ready for an underwrite until they've submitted some basic paperwork. And so there are some folks who just reach out to us to understand what we offer and what we might be able to do. It's more initial inquiries, getting ready to work with us farther into the future. But typically, if there's a time-sensitive opportunity, this land is already for sale or coming up for sale, we see a pretty high percentage rate of people moving through our process. So unless something really comes up that shifts, like the land, becomes no longer available, or, something comes up in the underwrite that makes us uncomfortable, we would typically proceed with that person. We generally quote to prospective borrowers or lessees that the underwriting process takes about 3 months, and some of those factors are outside of our control. Typically, when we're working on the financial modeling and all of that, it's dependent on how quickly they can get us paperwork. But sometimes the appraisal process can take a little bit longer. That's something that we're working with third parties on. And depending on the time of year, that can either happen really quickly or not. Sometimes we also see hangups with the title insurance process, which is another third party aspect at closing time. So we believe that 3 months is sometimes average, about the quickest that we would generally want to quote to someone. But there's always variations. Sometimes things can happen more quickly. Sometimes things might take a long time if some aspect falls through, and they might lose that opportunity and then might come back, in a few months or another year with a different opportunity. There are 2 more questions that I think would be better saved towards the end. So thank you for those, but we're gonna, that could take some time. We have lots of thoughts on those. So now we're at kind of the support the transition. That refers to a few aspects of what we do. For example, our leases, when we buy land and lease it to a farmer, usually, most often, we're buying land that was farmed conventionally, and the farmer will have to take it through an organic transition, which is a 3-year process. During the first 2 years, when they're farming it organically, but the land is, not able to be certified organic, their crops are potentially not getting the full organic premium. We offer a subsidized rate during those years, so it's a little bit lower. And then once they reach organic certification and they can capture the full premium price, we will escalate slightly what our lease rate is. Another way that we support the transition is through our own soil restoration pool program. So that is a program that we are able to make grants to the farmers we work with that is funded by investors through the soil restoration notes. And so by not taking a full return, the investor has created a pool where we're able to provide grants, typically from $500 to $8,000 is the current rate. And so we have seen a really wide variety of projects. We've supported, agroforestry, some work around wetlands. We've supported composting projects, and we've also seen transition costs assumed through that program. I should also mention that we have a grant with in the state of Illinois where there's a pilot program going on. It's called the RCPP program, and maybe I can remember what all that stands for, but that's basically, there's a pilot in North Central Illinois where there is they're actually funding farmers for for the organic transition, and so there's an incentive and an offset. So the government is offering money to folks in certain counties, sometimes about $200 an acre to support that transition. And so we've been able to work with farmers that are in those counties and eligible for the program to make sure they get some payments. I can answer to have we worked with farmers who are new to farming. We do have that 3 to 5 year requirement. And so we don't want to work with someone brand new because typically there's a lot of learning curve. We want them to have at least some form of established business model and to have some experience with the organic transition. There's also, I will say that there's a lot of opportunities through the government to support beginning farmers. And so we do always try to make sure that people who are eligible for programs through the Farm Service Agency and their beginning farmer rancher offerings that they take advantage of those. And so sometimes there's opportunities to partner, but we always want to support people getting what they can. All right, so I think we're now at this prioritize the triple bottom line. Hopefully you can see that's something we've been trying to do this entire time with farmers as we're evaluating opportunities and juggling a lot of different metrics and trying to understand the full picture of what they're doing. We generally, this is another area where the relationship manager comes in. I think that was a question at the beginning. What do relationship managers do? Basically, they walk a farmer through this entire process and then continue to work with them once they are within the portfolio. And so we know that things don't always go according to plan. And we also want to be there to celebrate the successes. And so this is kind of our ongoing, what's changed on the farm, how are you growing? Are there reinvestment opportunities that are coming up? We typically have relationship managers visit the farm once a year or once every 2 years, depending on how remote they might be. Generally this is where we're collecting their annual organic certification documents, and we are generally just trying to be as supportive a partner as we can throughout the life of our investment. And so that leads to being able to communicate a lot of those ongoing opportunities and those impacts to our investor base. So I think that, there's a question of how does our due diligence differ from other farmland funds or lenders? I think that, there's a lot that we don't necessarily know, but I think that our general approach is very different based on reacting to the farmer need first. I think a lot of different operators in this space and investors in this space are looking for land that's, they can potentially put place farmers on, or they're looking specifically for a more regionally impactful opportunity. I think that Iroquois Valley is very open to what comes our way, and we are, working to be more proactive in developing some strategic priorities around what our portfolio grows into. But because we're always underwriting the farmer more than the specific property, we're not looking on sales listings. We're not looking for super high value land necessarily. We're looking for land that may be really high value, may be less, maybe lower quality soils, but it's because a farmer has determined it's land that will support their business. And so we're looking at it from that angle. I think that, probably we have a lot of similarities with other investors when it comes to, the financial due diligence and how we evaluate our metrics in the ongoing way. But I think our biggest differentiator is really our general approach. I think the fact that we're not a fund either is a really big aspect of who we are. By that, I mean that when we're able to hold the land indefinitely. And so when we make a promise to a farmer of, you can lease this land, and at the 7-year mark, you're welcome to purchase it from us, but you're also welcome to continue renting it from us as long as you'd like, or until you are ready to purchase it, which maybe never, maybe multiple years from then. A lot of funds might take the approach of, we're holding this land for maybe a 10-year timeline, and then we are selling it at the 10-year mark in order to generate our investor return. And hopefully the farmer will be able to buy it, but if not, it's being sold regardless. And so I think that our model allows us to really maximize impact, because there's a lot of studies showing that farmers will invest more in the land when they have more land security, and will engage in more conservation practices when they have that land security. And so I think our model allows us to keep that promise in a different way. So I think the last question maybe that fits to answer on this slide is, how do we think of ourselves compared to other players like Farmland LP and Mad Capital? Similar approaches and audience, more focused on keeping farmland ownership. Yeah, we're all engaged in this space from slightly different angles. I would say that Farmland LP is one of those more specific approaches. They're really based on the West Coast. I believe they're not looking to expand beyond there, from what I've understood. They do work to, specifically looking at farmland. They take an approach where they actually manage the farmland as well. So they work with land managers. They have an approach that includes high value crops. And so I think a lot of what they do is, while it's organic and, we share that focus, they're doing a lot with high value crops that you would see in that part of the country, which are, grapes or berries, that kind of thing. And they're managing it. So they're not necessarily working with individual farmers like we are, who are evaluating and implementing their own business plan. Farmland LP is also a fund, and so what they're doing is much more specific and timely and related to the land and what's possible to grow on the land. At that time, they're also, I think probably something we all have in common is that we're working with organic farmers and are interested in converting large amounts of acres to organic. Mad Capital has been someone we've been able to partner with and refer some farmers to. They have they do some lending that we just don't do. They work on an infrastructure level and with equipment, and so with our lines of credit, we typically like them to be general operating needs, and we're pretty specific. We like to have a relationship with the farmer, on a land base before doing it. It's not something that we offer really widely. Mad Capital is also newer, so it kind of remains to be seen like what niche they find. But these are all organizations that we know and that, you know, generally seem to be supporting the same movement as ours. But I think Iroquois Valley is much more oriented towards the farmer and making sure they have land security and ongoing viability. And that's why our portfolio is so diverse and spread in these 19 states. It's really that reactive model of this is where we're seeing. We don't look at a map and say, it'd be really cool to be in Oregon. How do we do that? You know, it's much more dependent on what we're seeing. So I think we can go on to the next one and get into an example. I'm going to let Alyssa start off with this one, and then I'll fill in some of the blanks. But this is one of the investments that we made in 2022, and it represents a lot of new opportunities for us.
Yes, thanks, Claire. Yes, Justin Butts was a deal did. Justin is a BIPOC veteran, came to us looking to purchase some ground in New York for his operation. In the course of his underwriting process, we really, it generated a conversation around how we are underwriting opportunities for underserved demographics. And it really kind of kickstarted our R&R conversation around how we can better serve these underserved demographics and give them opportunities that they're not able to find elsewhere. So over the course of underwriting Justin's deal, we came up with a new qualitative baseline for these rooted in regeneration program opportunities. And basically these extra guidelines that we do during the process are factors that we are considering are, okay, maybe they don't meet our credit score requirement, but is there a reason that their credit history has been affected? For instance, in Justin's case, he was a veteran and had been recently done with his service. So he hadn't had a great opportunity to even establish credit in his life so far because of his time in the military. So we are looking at additional factors such as credit history. Are they part of an underserved demographic, which we are operating under the USDA's definition of underserved demographic when we look at this factor. And we're also looking at the deal size. Is it less than $500,000? So these were really some main factors we wanted to look at for these types of deals and see if we could analyze them in a way that gave them the opportunity to get on the land at a rate that was appropriate for their situation. So based on these factors, it is actually a rate reduction factor that comes out of those additional factors. So they go through, anybody in the Rooted in Regeneration program goes through the same quantitative assessment that any farmer would go through in our process. There's just these additional factors that if they are hit, we are looking at what we can do in terms of a more favorable rate to help these opportunities flourish. And it does currently go from a 0 point reduction up to an entire point reduction in their rate, depending on how they score on those additional factors.
Yeah, so this one was really interesting, just to kind of paint the picture. We learned about Justin through someone in our network who referred him and was associated with the land that was up for sale This is, a person who had a lot of experience working on farms, but not necessarily someone who had the opportunity to ever manage their own land. They've been able to carve out a lease on a different farm before, but generally was moving with a small herd of pigs for a few years, and establishing his first business was lard soap, and he was able to keep that going. But he has a really interesting background. He's also a chef at a college in New York State. And in addition to being a veteran, had gone through the Soulfire Farm Braiding Seeds Fellowship program, which is kind of a mentorship program for BIPOC farmers. He was also the livestock manager there, so that was part of his experience. So this is someone we might consider like a newer farmer, in the sense that they don't have a history necessarily of managing their own business consistently over, the same period of land. This was his first farm that he was able to get on, and it's a really interesting property that provides the opportunity to invest in conservation practices as well. That was definitely a factor that we were looking at. Was he was really excelling when it came to kind of the best practices that we would want to see from folks. And so there was question of, why are there not more permanent crops in the portfolio? There's a lot of ways to answer that, but one of the things that we see is not necessarily that there aren't, but that might not be the forefront. We do have folks engaging in agroforestry when and where appropriate, but that's generally not the primary business model. But this property is high on a bluff, and it's kind of susceptible to wind erosion. And so he will be planting a windbreak that will also help restore some wetlands and riparian habitat. And so that will include berry plantings in addition. And, there will be some trees. We could also consider perennial pasture, kind of a permanent crop, but generally that's supporting livestock. So with this opportunity, we were really saying, he's doing pretty much everything we would want to support, and yet he's not necessarily coming out in the part of, our risk assessment that would show that he is a pretty de-risked investment, in terms of he has all this community support. He's learning from other folks. He's very engaged. I think there was also a question early on about conservation easements, maybe beforehand. Someone submitted that, and he's on the board of a land trust, and this property has strong conservation easement potential. So we like to support that wherever possible. But there were a number of factors that made us understand that, if he's not coming out at the bottom of our lowest risk category, maybe we need to shift our own risk assessment to better accommodate potential borrowers like this, who we would like to be working with, and that, are parts of communities where we can potentially work with more of their community, whether that's, through the fellowship that I mentioned, and other farmers that are potential for that. But we're excited about this. This was the first pilot. We've since worked with another farm and have been able to apply this same risk assessment. And if we go to the next slide, this is one of the big initiatives that we're working towards this year. So we have a conservation innovation grant that we were able to shift in this direction, and it's really going to be all about that purpose of working with investors to fund ownership for the socially disadvantaged and underserved category as defined by USDA. We just hired a new relationship manager who will be starting at the end of the month, and a lot of her work will be honestly working with the investor relations team and helping to structure this note so we can get it out to people. But especially working with farmers and organizations so that we can better understand if our intentions and intended outcomes are coming through with what we're designing, and starting to develop that as an aspect of our work so that we're not just reacting to the folks who are coming. And we are seeing more diversity in that respect, but we have a large pipeline and a lot of folks coming through already, and so we understand that we need to make this an intentional priority if we're going to make progress on it. So the current thought is that this will take some inspiration from our soil restoration notes, so that we can develop a pool where we can fund that discount mechanism to the borrowers, according to the risk assessment that Alyssa mentioned. And so with that, I think that we're ready to move into more questions. And yes, that is correct. We will be issuing a new note to support BIPOC farmers and farmland ownership. That is the big picture work.
Kathy, thank you for the solstice information. I had not heard of that before, so I'll have to check that out.
Yeah, I think to get into Andrew's question about hydroponic and vertical farming, that is a huge debate within the organic community, whether hydroponics should be allowed or not. The Real Organic Project, which I mentioned, takes a stand on no for that. And generally, that's kind of an issue we don't necessarily have to think about too often, because it's just not, we don't get a ton of inquiries from there. Or at least from farmers engaged in hydroponics. We have said no to opportunities in the past, and I suppose we would be kind of skeptical but open to evaluating in the future should other opportunities arise. It would be something that we would probably need to get some direction from as a strategic priority, whether that's totally off limits and we shouldn't consider it, or whether there's special cases where it might make sense as part of a larger operation. We anticipate offering this note. Sorry, I'm just switching to the next question. Hopefully that answered the question about hydroponics. We anticipate early summer. So the person is coming on board at the end of the month, and we're already working on a number of factors. And so we're definitely hitting the ground running and hoping to launch as soon as we can. I also see this question about difference in organic versus non-organic inflation rates, and that's a fascinating question. I don't know the answer to that. I don't know, Alyssa, if you do, but I would love to do some research and find out if that's bearing out at all.
Yes, I don't have anything to add to that either, but it is an interesting question.
Will we be building? So the Farm Foundation and their new Education and Innovation Center in Libertyville, Illinois. I'm personally not familiar with that one, but it's possible there are others on our team who are. I would love to learn more about that and find out if there's ways that we can or should be engaged with them. But yeah, if it's about supporting new farmers, that sounds valuable. I guess I could also add there that we do work, there are all sorts of stats about the average ages of farmers, and succession planning is something that we look at in every single investment, and how the investment will work over the course of time. But when it comes to working with new farmers, we do work with many farmers who have initiatives to work with new farmers. So we've either worked with the incoming generation or we've been part of the succession plan. One of the farms that we work with runs an apprenticeship program, and there are lots of farms that we work with that are specifically trying to address ways that we can get new agrarians into this space. So it's something that, you know, if they're right at the beginning of their journey, we might not be the right fit for them, but we're definitely thinking about them and working with folks who are engaging them, and we're working to be a resource for them in the future as well. Oh, okay. So I understand the question now with Michael. Are we seeing increased investor interest because of inflation? I don't know, Donna, I mean, farmland is definitely a great hedge for times like this. So I'll pass it over to you all to answer that part.
Sure, and great question. I think most of our investors are really mission driven more than financially driven. However, I do think that there are several who have said to us, you know, before they came in or recently after, that they are looking at our investment in farmland as an inflation protection. So I think you're 100% right. And great question.
Yes, we are using the USDA definition for underserved, and women are a part of that. So I think we showed that previously, but we have 70% of our portfolio already includes women. This would be an expansion of that. So there's some slight differences between underserved and socially disadvantaged in terms of definitions, and we are going to be looking at both of those and considering both as we develop the program. Well, thank you for the questions. I think we have a bit more time to take
one more just came in.
Oh, the Farm Bill. Yeah, what a big topic. One of the things that we do, we don't necessarily have a lot of capacity to work on policy ourselves, but we do sponsor and support financially the Organic Farming Research Foundation. We have a long-term relationship with them, and they are they make a lot of policy recommendations, both to administrations, and then they're very active as it relates to the Farm Bill. Within the course of our relationship, one of the initiatives that we did was they do a number of listening sessions around the country, and we were able to have Iroquois Valley farmers participate in a listening session with Organic Farming Research Foundation so that they could take those and include them in terms of recommendations for the Farm Bill. Organic is typically not massively funded in the Farm Bill, but we've seen some improvements, and we hope to see a lot more. But typically we're working with folks that are engaged on the policy level. There's also the National Sustainable Agriculture Coalition that we work with, and then a lot of our staff have different relationships with other policy initiatives and folks working on that. We try to get our farmers' voices heard, and they do that themselves a lot. So we work with a lot of farmers who are engaged. We work with a farmer who's on the board of the Organic Trade Association. We also have folks who participate in kind of Washington fly-ins where they speak with leaders about their issues in their state. there's, you know, farmers union and people engaged on their soil and water conservation boards. So I would say that the farmers we work with are definitely thinking about policy, and the Farm Bill is a massive opportunity every once in a while. And we are strategically interested in seeing more support for organic and organic programs. So like I mentioned, the RCPP, which funds conservation, or which funds the organic transition and offsets it with payments. That was an initiative that came out of the Farm Bill in the past. And so it would be interesting to see if that gets expanded on a wider basis going forward, because it's only in select counties at the moment. But there are lots of really interesting programs, and we will be keeping an eye on it. So yes, so our Rooted in Regeneration program is really aimed at supporting farmland ownership for socially disadvantaged farmers, many of whom are, you know, Black, Indigenous, and people of color. We have hired someone to help us achieve this project and get some progress, get it underway. We anticipate opening it in June, July. We're currently working on some of the legal documents, and we'll be working on that probably through the second quarter. We have already piloted it with a few farmers and are looking to launch this on a more wide-scale basis so that we can support more farmland ownership opportunities for socially disadvantaged farmers with investor support. And feel free to add anything to that, Donna.
No, I think that's great, Claire. And we are coming up to the end of our time. So I would like to thank everybody for attending today, and thank Claire and Alyssa for walking us through the farmer diligence process and providing insight to the work that they do every day. I found it really helpful, and I hope you did also. But before we sign off, I wanted to let you know about some exciting leadership changes. Chris Sulzdorf has recently been appointed as CEO of Iroquois Valley. Chris has been serving as COO during his tenure with the company. And during this time, he's earned the respect of the staff and the board. Under his leadership, we are looking forward to growing and becoming more impactful in the years to come. In a quick summary of 2022, to kind of reiterate that point, with your support, we grew our revenues by approximately 13%, closing 20 new farmland investments. And I think Claire mentioned we added 3 new states to our portfolio. Our fund from operations, which is similar to net income for agricultural companies, decreased slightly, about 4%, due to an increase in bad debt expense. This increase was because as we add more farmland to the portfolio, we want to continue to be conservative in how we account for the potential downside of some of our investments. Fortunately, we developed strong relationships with our farmers, and the team works closely and hopes to resolve some of these issues with farmers who have faced some challenging times. Our share price has had a nice rise over the last 12 to 18 months, significantly in between the period of 21-22, and the stock is now valued at $730 per share. So overall, the company's financial situation is healthy. We don't expect any further turnover on the staff or the board. The team continues to demonstrate stability and resilience, and everyone is passionate about our mission. So a formal announcement will be sent out first thing tomorrow morning with more information about Chris's appointment, including a copy of his bio. But if you have any questions at all, please reach out to Lacey and me. We're always happy to speak with you and answer any further questions that we can. And finally, as Claire mentioned, stay tuned for more information about the R&R notes coming out this summer. We're really excited about this project, and we look forward to being able to talk with you about it. So thanks again. We really appreciate your continued support and work hard to make sure that we're making a large impact across the agricultural field. So have a great day, and we'll be in touch. Thank you.
Thank you.
Thank you.